Hi and welcome to Disruptive Innovation. My name is Elias. I'm a former airline pilot, and today we will be talking about a possible stock market crash in 2021. So first of all, let's talk a little bit about what a stock market crash is. Now, I personally don't really like the term crash, as a crash, as I see it, is something that is not able to recover. I would rather call it a correction. And if you look back in history, as far as I know, at least there hasn't been any case where the stock market has not been able to recover. So 2021, we might be looking at a possible correction. However, we are not looking at a crash. In financial terms, a bear market is when the stock market goes down somewhere around 20%, whereas a collapse is when it goes down somewhere around 50%. Now, back in 2008 and 9, it went down somewhere around 50%, which means that qualified for being a collapse. However, since then, we've seen quite a big bull market, so that tells me that there might be a correction coming. Now, we've just seen it the last couple of weeks, especially with some of the growth stocks that have went down somewhere in the region between 20 to 25%. So from here on, we should hopefully see a upside. So what is it that actually is creating all these ups and downs all the time? Well, if you look at the stock market in itself, and especially with COVID-19, a lot of investors have moved into the stock market because they have excess money that they don't know what to do with. So what that means is that there will be a lot of inexperienced investors in the stock market which are going to react a little bit unpredictable. Now that means that a lot of people will fear when it goes down and they will sell when they should have bought, and the other way around. So to take one example, let's say that we have two individuals, person A and person B, but both of them are in the stock market at the same time, dealing with exactly the same ups and downs. Now, let's say that person A intends to buy a stock on day 1 and sell it at day 7. So he buys in at exactly the same time as person B does. The only difference is that person A is looking at the stock chart every day, which is moving up and down like this. Whereas person B, he buys in on day 1 and sells at day 7 and doesn't look at the chart at all during that week. So what is the difference? Person A is looking at a chart which is going down and up all the time. So he believes that he's losing money on some days and he's earning money on others, whereas in reality he has neither lost anything or gained anything. Because in fact, the only time you actually gain or lose something is when you sell out, right? So whereas person B, on the other hand, he bought in on day 1 and sold at day 7, never looked at the chart, but earned the same amount of money on the last day as person A did. So what is the difference between the two? Well, one of them is possibly going to react sometime during that week. He might sell out or he might buy in at the wrong time. Whereas the other person who never looked at the chart and is more long term is going to be a little bit more stable. Now, since COVID-19, a lot of people have not been able to consume as much as they have done in the past, meaning that they have a little bit more excess of capital than they usually do. So when people do that, they start to look at different investment strategies and different places to invest their money. The stock market is definitely one of those. And we've seen a lot of examples the last year where people have gone in quite a bit more in the stock market than they normally should have had. So let's say you want to go into the stock market and you want to invest in something. Where should you invest the money? Well, we believe in disruptive innovation, and that means that we believe in companies and innovation that will change the world as we know it. Now, if you invest in companies like this is going to be called growth stocks. It's not going to be called value stocks, which are more established companies, bigger companies which have already possibly disrupted their own industry in some way earlier. Now, a couple of examples of these are the FANGs, so that is Facebook, Amazon, Apple, and Google. These companies are called value stocks because they have a high value which is difficult to tear down. You know for a fact that Apple is going to continue to grow. You might expect somewhere between 5 to 6 year-over-year average gain, whereas another stock, which is a growth stock, for example Tesla or CRISPR or Pacific Bioscience, are stocks that might go up 10% on one day. So we like to look at disruptive, innovative companies, companies that we believe have not really been discovered yet, at least not in the mainstream. And we believe that these stocks might go up as much as 10x and all the way up to 100x in the next 10 years. So the 5 sectors we look at is electric vehicles, cryptocurrency, biotech, robotics, and 3D printing. So these 5 sectors will most likely merge at the same time, and that is what makes it really interesting. Just one of these sectors alone would be disruptive, but having 5 coming together at the same time is going to be something special. This has only happened once in the past, and that was back in the 1920s. And that was actually only 3 sectors that merged at that time. So when should you buy and when should you sell? Well, consider this. If you would walk into a store and you would see that they had a 20% discount, you would most likely go into that store and at least have a look if there's something that would suit you, right? But why do people hesitate to buy in when they see a 20% discount in the stock market? The simple answer is fear. The problem in the stock market is that there is a lot of psychology, and especially the more small investors and unexperienced investors there is, the more psychology will be in the stock market. So people hesitate to buy in when they see that a stock has dropped 20%, and the reason for that is that they fear that it might lose another 20%. So they want to try to time the market. And I don't really think that that is a good strategy. Warren Buffett once said that it is more important with time in the market than timing the actual market. Because consider that you would buy in at a certain point that you believe is the dip, so at the downside, but it continues down and continues down even more. So you sell at that point because you fear that it's going to continue even more. But instead what happens is that it moves up, and when it moves up you buy in again, and at that point it drops down again. So by timing the market you can actually lose out twice. Whereas if you would be long term and you just maintain time in the market, meaning that you buy in at a certain point and you create conviction enough for you to be able to stay and bear with all the ups and downs all the way till the end and then sell off, then that is going to be a better strategy. So who should you listen to when it comes to investment strategies? Well, the simple answer is yourself. You're the one who owns your own capital. You're the one who will have to take responsibility if it goes up and down, and no one else is going to do it for you. So you got to listen to yourself, do your own research, and by doing so you can create strong conviction. So there's always going to be people around you who are going to tell you stuff that you don't really want to hear, and especially when the market goes down and when there is a big correction. A lot of people which are inexperienced are probably going to tell you to sell off in a situation where you should buy more. So when people are reading the headlines in the newspapers where it says that the stock market has gone down 20% the last week, that creates a lot of fear. And a lot of people that don't know much about the stock market are going to tell you to sell out. So you shouldn't listen to that. You should listen to yourself, do your own research, and make sure that you have a strategy that suits you. We're living in a quite interesting time. The thing is this, you don't really have to be the next Elon Musk or Jeff Bezos or Bill Gates to be able to earn big capital. The only thing you need to do is to join the same boat as these guys. So what does that mean? Well, the thing is, the stock market is somewhere that you are able to buy into a company that you believe in. You don't have to reinvent the wheel. You don't have to be the next Apple and invent the next iPhone. You just don't. The only thing you got to do is create enough conviction, believe in a product and a company that you are investing in, and you will be earning money if you just become part owner and buy the stock. So if you like the content, please consider to like and subscribe. And if you want more, we have a Patreon page where you can become a member. And by doing so, you will have direct access to our forum, our Discord server, where we are a bunch of people that come together to discuss, analyze, and invest in companies that we believe are part of the future. The whole agenda is to become financially independent, and we want you to be part of that. So please head on to Patreon, have a look. We have 4 different levels of membership. They are called Light, Premium, Pro, and Platinum. And depending on which one you choose, you will have access to different parts of the server and be able to communicate with individuals of that specific level. So for instance, the platinum level will give you access to my personal portfolio in real time. You will have access to my watch list, stocks that I look at and intend to invest in. And we also run live Q&As where you can have live discussions, ask me questions, and try to become a better investor. So with that said, I would like to thank you very much for tuning in, and remember to always invest in the future.